Good evening, good afternoon, good morning, wherever you are in the entire world. Welcome to the Hidden Edge Podcast Late Night Edition. I got my boy Kris over here and myself, Sam Solid. Good to see you guys again. Got a lot of newcomers here as well. We are launching this stream around the entire world, of course, but we're going to be discussing things going from about the Moody's downgrade, which was, let's be honest, that was quite a nothing burger. We're going to go over the rates. We're going to talk about the Nebius earnings, which is actually up about 5% overnight. Pretty crazy. And we're going to go over the NuBank earnings as well.
They didn't report yet. I thought they reported tomorrow morning.
They didn't report yet, man. Retail's getting a little crazy overnight. I'm not going to lie. There's 360 people in the Nebius community on Twitter.
Stop pumping this, bro. We're trying to accumulate a position and you pumping this, man.
I know. But if you're new here, happy to have you all here. But of course, our YouTube channel over there. And if you're new here again, don't forget to hit the notification button, the like button. We have basically have an episode every single week. We had last week's episode go public. Yeah, what a day. Honestly, yeah, go ahead.
Nebius is up 90%. All I'm doing is waiting to freaking have my taxes clear. And I was like, oh yeah, I'm going to dump some money into this thing. It's just, thanks a lot, bro. Thanks a lot for giving it away.
You're welcome.
Thanks a lot.
Honestly, you could buy now and be annoyed if it pulls back, but then you'll be happy that you're in because probably in a few years,
I'm cheap.
Be wishing you could. I know you're cheap, but I honestly feel like this is not something that I want to swing overnight or whatever. Don't get me wrong. I sold some puts on the stock before close, but at the same time,
did you see this? Hedge funds have been loading the boat on this thing. I don't know if you can see it on my camera.
You know what? I haven't been looking at that thing on Robinhood.
Q4, almost hedge funds. Let's see. They had 67% net buys, 8.84 million shares. And now retail's been jumping. This is another cool feature about Robinhood that I really like. Retail has been buying too. I think my screen might be flipped. I don't know if you guys can see it, but basically
no, it's flipped. Yeah.
It's just been, God damn it. Man, I should have bought this about a month ago.
Dude, it was amazing. When this thing was the 22s, I was like, I have to buy. So I brought my average down because my original average was $27. And I had to bring the average down. But yeah, I'm sitting at 2.5% of the portfolio at $24. And to be honest, I don't know if it's going to get there unless people get really bearish on it. But the fundamentals are really good. And I don't want to jump right into Nebius yet because I know a lot of people here for that. But we definitely got some broad market stuff to talk about. And if you're new here, we really talk about things other than just single retail stocks. We kind of go over pretty much the entire market. Obviously, the focus on equities because we're not, hedge fund investors. We can't really play the futures market and treasuries and so on, but we can attack the ETFs that are trading that do cover or follow the futures positioning. So namely, the Moody's downgrade, when I saw that happen after hours, I got a little worried, but after doing some research over the weekend, I could share some stuff here, but
Before you do that, I got a clip for you, bro. You got to play this real quick. There's not going to be swearing in it. It's no. It's fine. Right. This one's specifically towards you, bro.
Oh my goodness. No. I don't like it. I don't like it. Yep. No, I'm not playing that, dude. I'm not doing that anymore. All right.
Come on, man.
If you want to do that, we could do a private YouTube stream with zero people attending, and we'll play it on there. But I'm not playing Chappelle's show on here, man. There's gonna be let's just say we probably got some newcomers in here. Might take it a certain way. I don't want to do that. All right. Anyways, let's get into the Moody's downgrade. All right. So, what were your thoughts? You still there?
Yeah, I'm right here.
Oh, okay, it froze for a minute. Maybe that was just me. But what were your thoughts about the Moody's downgrade as soon as you saw it drop on Friday afternoon? Initial thoughts.
Kind of late to the game, no? S&P and Fitch had already downgraded us quite some time ago, so it wasn't anything that happened recently. Moody's was a little bit late to the game, but they are the
A little bit.
final. They are the final boss in this AAA game. So I mean, that's the only part. So I think the market reaction was somewhat, somewhat justified in that it just, created some sort of fear. But I think the markets, once they really realize that, they just kind of say, oh, well, this is just, everything's already baked in. I think the first time it happened, the market kind of freaked out, but after that, it kind of, got things to be normal. So I think you said it correctly on Twitter, where you said, the market's already adjusted for this. It's like it's nothing that's going to change it. Not to mention, from an investment standpoint, AAA and AA1 is not that far off. Like, it's not like you went from investment grade to non-investment grade. Like, that's the challenge. The problem that I see, honestly, though, is that if we start to get another cut from, let's say, S&P again, then you've got a problem. Because the thing is,
beyond the level we're at, because they're all the same level now.
Right. The distance between these downgrades is the thing to watch out for when it comes to debt, right? So the way that typically debt works is that if you go from, like, let's say investment grade, like let's say AAA, and then it took you 10 years to get to one notch below, and then it took you 5 years to get one notch below before that, after that, and then it took like one notch below, it took you almost a year, and then a year, so that acceleration is a major thing that you have to watch out for when it comes to, like, let's say on corporate debt. On sovereign debt, it's not nearly that big of a deal, because the thing is, like, you're talking about upgrading and downgrading centuries, like not even centuries, I'd say decades, So, but the thing is, the general direction of where the US is headed from a fiscal standpoint is not good. And honestly, there's some hard decisions that this country is going to have to make over the next 10, maybe 20 years to get to a level that, I would say puts us in a much better footing. And it's happened. Like, we blew up the deficit during World War II, but then we were the only manufacturer in the world and services provider that was untouched by the war. We had all these factories that were created during World War II. So we were literally building, and that's why we had this great prosperity in the 1950s and 60s. And the thing is, that prosperity is what allowed us to deleverage. The challenge right now is that we're under this great prosperity thing right now with AI and all this technology and energy being with us. But instead of using that prosperity to say, let's make those decisions now while it's palatable and bring that deficit down, bring the spending down, and bring the debt levels down, all we're doing is saying, let's just keep spending. Because it's inconvenient for both sides. The Republicans never want to raise taxes, and the Democrats never want to contract on spending on social programs, So each side, if they were to come together and create a longer term solution, they could actually get us back to a point where we're in more prosperous zones again, right? Structurally, other parts of the world are all suffering, and we're actually doing really well. But usually what happens is, like any other household. If you're making money and you're doing really well, that's the time when you save money and you invest it into the future. You don't go out there and you blow it on things that are not going to provide you a tangible return way out into the distance, into the future. So,
yeah, I mean, wholly, I agree. I mean, from a market perspective, when it comes to the downgrade, I actually have I posted an article about it, and I wanted to bring it up real quick. I should have had this ready now that I think about it. But anyways, here we go. Oops, hold on.
Someone said quickly, someone said bonds are a thing I didn't understand in school. Bonds are just an IOU. That's all it is. You have a bond is basically, you lend me money, I pay it back to you in the future with interest, right? And that's it. That's all a bond really is. I mean, it gets complicated once you dig into each different types of bonds, but that's essentially what a bond is. It's just debt.
Okay, so there's this chart that I had over here, and if you guys want to check out this article, I put the link. I'll put the link over here and just bring it up. But in this chart, like you were saying, we had we had the S&P or Standard and Poor, these are the three credit agencies for the U.S. We had the S&P in 2011. They actually downgraded the U.S. debt from AAA to AA plus, and this created a storm, right, per se. What happened was that there's a lot of contracts that are written that actually buy the U.S. securities or by the treasuries. And once this did happen, the stipulation in a lot of these contracts was that they could only own AAA securities, right? So once Standard and Poor credit agency downgraded the debt to AA plus, which is still high grade, if you could see from this chart, it created a storm with all of these entities that owned a lot of securities. So they had to immediately sell it because it didn't abide by the contract or the terms of what they could actually own, right? So the market ended up seeing a 10 to 20% drawdown very quickly. But this is, of course, coming from 2008. So, people thought that the market was going to make a lower low from 2008 and so on. And, it really cascaded into a huge downtrend in the S&P 500. And the market actually closed about 6% down the following day that downgrade did happen. But those rules are rewritten in the contracts, basically saying that instead of having AAA securities, they could have just U.S. securities, right? So U.S. debt securities. So in that case, if there was another downgrade, it wouldn't really matter for a lot of them. Fast forward to 2023, Fitch downgraded, and I think a lot of you guys remember this, it's just a couple of years ago. Fitch downgraded to AA plus. So they were the second agency that caught up with that. And the market didn't really drop like 10%. It dropped 10% over the course of 2 months. But the next day we closed, I think, like about 1% or 2% down, right? So it was a much more muted effect as a result of that second downgrade. But overall, the bonds did trend down. Actually, we're lower in the bonds, right? We're almost at those lows in the bonds, but we're obviously much higher in the stock market. What we saw on Friday was Moody's, finally the last credit agency, as you were saying, downgraded to AA1. And these are all still the top tier and high grade, but of course, a much more muted effect as we've seen. Everyone was posting on X, including myself, after doing research on this, and we closed up flat in the day. And a lot of people really thought, okay, this is it, guys. This is the reversal right now. And I feel like there are too many people that are counting on that. And when I say too many people, I'm talking about like heavy position hitters on the market. They're preparing for it, and too many people were prepared for it. And you basically had the effect of it after hours as far as the aggressive selling. And today you expected that, but it was literally at the open, opened at the lows, and just trended up higher the entire day. And just a bunch of short covering throughout the entire day. A bunch of people caught offsides on it. I'm not going to lie. I kind of braced myself for it. But to be honest, I didn't have any shorts coming into today. And I was kind of worried, like, oh, crap, I have like 0 hedges on, right? Lo and behold, we did end up closing flat in the day, which is, in my opinion, a very bullish sign and another affirmation that we're in a melt up right now. And people ask, like, what's a melt up, right? A melt up is literally like when you have dips being bought relentlessly and the market just trending up over a short period of time with very little drawdown, right? And when I say melt up, I mean like the market is like just this over time, but it's going in the upright direction to the point where like it is a hated rally, right? Like this goes back to 2023, where it was the most hated rally we've had since October 2022. And I think this is kind of mirroring that, right? Like we hit the lows in April 2nd. We had a 23% drawdown on the S&P 500 inch and day. And we've literally just bounced since then. I want to say up and to the right. It was very volatile, right? Like we had that 10% up day, and then we did a 50% retrace, and then we went up and pulled back a little bit. Like I gotta be honest, like it wasn't up and to the right. I felt those emotional swings during the entire time. But I mean, here we are, against all odds above the 200-day moving average, and people are just looking for a reason to, I guess, short the market still.
I think this was one of those times where I think as TLT gets, not just TLT, but as bond yields get to a certain level, I think there's a lot more belief that there's going to be some intervention coming in from the White House / the Fed and everything else. So one of the things, and the reason why I'm in TLT, I think as a hedge, is because I expect action from the White House, because, you know, I know that when you have these periods of basically downward moves in the treasury market, it has second order effects that are way into the future that can cause major problems. Like, one of the things I've been privately researching right now is CMBS, commercial mortgage backed securities. And one of the things that I noticed, actually, and it might actually relate to this, is this giant drop off in rents. Let me just show you the, and this is happening across the sector. I actually posted this on X just to get feedback from people, because this is something that's not necessarily being spoken about very much, but actually is kind of important. If you look at this is the rental markets, and Zillow does this more current than other sites. But one of the things that you're seeing is all like markets all across the country, you're seeing this giant drop off in rents. And it's literally just happened between April and May. I don't know if this is just a distortion of data that's coming from Zillow, but one of the things that I'm seeing is this massive drop off in rent, or at least new rent that's coming along. Los Angeles is the same thing, right? So you can see it's drop off from April to
Wait,
May.
is this a survey, or is this actual?
No, based on median
Registered
rents.
median rent.
This is like
okay,
median rents from Zillow, like Zillow's actual like data that's coming across, last updated like May 18th.
that's interesting.
So, yeah,
I wouldn't expect that when I think about it.
yeah,
Rent,
I wouldn't
average
expect it
rent over
either.
time. Maybe the rent
Yeah.
market is cooling off, which is great, but I certainly don't see that in LA from what I hear. But then
Yeah.
again, LA is dropping off. Interesting. That's
Yeah,
interesting.
I mean,
LA is like a little bit late there, but it's like
the
just
thing is
falling
like,
off.
yeah, and the thing is you have to look at it like from the actual data points. Like, you can see like different neighborhoods and stuff, and like Beverly Hills, I don't know, like give me a neighborhood that's somewhat important in that area. Like, let's say Culver City, right?
Yeah, Culver City is a good one. You could do
Yeah,
West Hollywood as well.
like there was an uptick in April, but then it's like dropped off a significant amount. So my thing is like, what is going on here? Like, and you can actually explore the rentals in the area and
Can you search
actually
Las
see.
Vegas? I'm curious. Las Vegas.
Trying to move out there, bro? What's going on? I know you keep visiting over there.
Yeah, no, might as well just get a place at this point. No, but I'm curious, like how Las Vegas turned out, because that was a mass exodus area that a lot of people moved to from LA.
Actually, let me go back to this thing. Hold on. Actually, I have to search for it. Choose another area. Las Vegas, right here. Yeah, look at this drop.
Interesting.
Part of me is thinking part of me is thinking that there's a combination of lease renewals that are happening at, and then you also have this pause in Section 8. So Section 8 housing, like this is something that I was watching, and this is kind of like I was wondering, like Section 8 housing payments delayed in multiple states. So my thing is like, what is happening? Is this somehow causing all sorts of issues with like the rental market in the background? Like I said, the data is too new for me to actually confirm everything. So my thinking was, and this kind of hit me. I was having bubble tea with my wife earlier today, and we were talking about COVID. And one of the things about commercial real estate, which also covers multifamily, is that when you have, I can X out of this. When you get these commercial mortgage, when you buy these multifamily houses, right? Like let's say a townhouse with like 4 apartments, whatever, you're not getting a 30-year mortgage. So that's for like single family. What you're getting essentially is a 5-year adjustable rate. So you're fixed for 5 years, and then after the 5th year, kind of adjust, right? So I think a lot of people might have bought these houses during COVID when interest rates were really low, and a lot of them are resetting now, like in 2025, right? Think about it. It's been 5 years since COVID. So maybe this is an early indicator that there's people that might be seeing distress. Another thing that I actually noticed also is this right here. The rental vacancy rates have actually started.
Screen.
Oh yeah. I'm sharing right now. There you go. Okay. You see this? This is the rental vacancy rates. What you're seeing is during the pandemic, rental vacancies kind of fell down. You know, people were not
They
being
bought houses.
evicted. People were not, huh?
Yeah.
Second?
Well, they bought houses, but also the rent market
Yeah.
was also hot for people who couldn't afford it. Yeah.
Right. And at the same time, you couldn't do any evictions, right? So I know
Yeah.
a lot of
Oh, that's true.
a lot of landlords, they wanted to, you know, rent out their place, but there's people that are just occupying the thing and you couldn't get them out because there's a moratorium. Well, the moratoriums ended about a year ago, but there were still all these programs that were kind of like keeping people within the system. And I think a lot of them are being kind of forced to move. And right now you can see like the rental vacancy rate, it's about 7.1%, which is what you know what it was. It's actually a little bit above what it was in 2019. So then I started digging a little bit deeper. I said, okay, let me look at some regions. And one of the areas, like let's say Denver, right? Denver rentals. Actually, I actually found data that like Denver apartments, the vacancy rates hit like a 15-year high and rents are dropping in that area. So I'm thinking like, hey, a combination of less immigration into the country. I mean, you think about it, we let literally like 5 million people at the estimates that conservative estimates, about 5 million people over the last 5 years. We've had this building boom in housing for multifamily. And now you're starting to see this complete cutoff of new immigration into the country, while at the same time, you've got deportations happening. So I think everything is like culminating into like
Do you think
a
that's
much
adding
more.
to it?
I mean, I think what it is they're just small amounts that keep getting added into it that justifies this drop off in rents, right? And the thing is, it's good for people trying to actually go and rent a home right now. I mean, that's
Yeah.
like, you know, people right now, you know, a lot of people are struggling with finding a place, and I think the more availability of homes is a good thing. But this is something that I have to like just keep digging into. I'm also seeing a lot more listings on like the housing websites. So, you know, if you look at the total listings, they're going up significantly, and buyer demand is actually not really strong. And with rates being around 7%, the number of people that can actually afford a median home right now is at, I think, like a 30 or 40-year low. You know, I mean, you're talking about like the affordability conditions are worse today than they were during the great financial crisis. Can you believe that shit? Like 2006, 2007. Like,
Conditions of where exactly?
so right now, if you are trying to buy a home, if you're trying to buy a home, right, the cost to buy a home right now, you would need a median household income of about
Oh
120,000
yeah, yeah,
for
no,
a
for
median
sure, for
home,
sure.
right?
Yeah.
So the thing is, a lot of homes are coming onto the market, and it's funny because I'm actually seeing price cuts during the springtime, which doesn't happen. If you think
Yeah,
about
it usually
spring,
heats up during the
yeah,
spring coming into summer. I w-
spring and early summer is usually when a lot of homes get bought up into the market.
yeah,
But
yeah.
you're seeing the average amount of like days on the market starting to grow in certain areas. So
Yeah, I would actually think that a lot of that might be attributed to people moving out of because the data that you were showing us from Zillow is mostly from metropolitan areas or at least concentrated areas. So I wouldn't be surprised if there are people who are moving out of those areas as they find remote work, but also people that are consolidating where they live. I see that a lot of that happening. You know, like this guy mentioned over here, Heartbeat said that Gen Z living with parents. You know, people moving back home. Like I said, people consolidating, families sharing a house, or families moving, sharing an apartment, and so on. I've seen a lot of that happen, especially living in LA. You know, so that could be happening as well as the job market continues to stay tight. Initial jobless claims continue to rise, so there's continuous jobless claims, and you know, I mean, I think that's going to continue happening. I think that's going to be a trend. But the thing is that consumer sentiment is pretty much near a big low. When you look at some of the data or some of the earnings announcements that you're saying, you know, even if this is consumer spending, it hasn't really materialized to a point where it's dramatically hurting the profit margins of a lot of these companies. If you translate this into earnings, earnings obviously fell off a cliff last earnings, but that leaves a good comp for quarter over quarter sequential results for the next earnings cycle. which is coming up probably in like a month, right? So I think I think that this information is important, but at the same time, I don't want to put too much pedigree as far as this right now, right? Because if and we haven't gotten into rates yet, so right now let's get into rates. If rates make a massive reversal from here, okay, let's say the 10-year comes all the way down to 4%, and the 30-year comes all the way down to, let's say 4.5% or 4.25. The Fed is definitely going to cut. Definitely going to cut. But at that point, it might start to heat up along with that upheaval in the housing market that's supposedly seasonally supposed to heat up during the summer. But if rates continue to come down, we'll see. The thing is, like you're mentioning earlier, as far as like the Trump put, all right. So let's think about the Trump put, which is at play. Like that was clearly at play on the night that the retaliation tariffs went into effect. I think it was April 9, right? So when that went into effect, it was like hours later, the following morning, before the market ran up 10%, that Trump basically postponed it for 90 days. And then since then, we had the UK deal, we had the China deal, and so on. So I think that argument that the bond market is front running the tariffs coming on, was a very good argument. But here we are after all this good news, and rates are still near their not all-time high, but their pivotal high. Actually, I would say near their like 5-year high, right? So that would be like 4.75% on the 10-year, close to 5% actually. I don't think we're going to get there to 5%, because that would put TLT around $82, maybe even lower. I think the pivot low was around $81 for TLT, and that was before all of the dividends, so it could be lower if we get there again. But at the same time, I think rates might have bottomed today. And if you look at the chart here, let me share a chart for the rates. Why am I sharing that? That's the wrong thing.
Well, the point that I'm trying to make is, I think if we aggregate all this data and just try to figure out, like, okay, how is this going to impact core PCE going forward? If this data is true and it seems like it's actually somewhat, logical, you're looking at a 6-month core PCE that's going to be well into what the Fed's target rate is going to be, if we're actually see negative moves on a large component, which is shelter. And so, like I said, it's something to keep an eye on. And I think maybe this is what the Trump administration wanted to engineer. I mean, unless,
that'd be interesting.
Maybe this is some 4D chess, but there are 3 to 4 things converging on themselves. And I think one of the guys that just posted on my Twitter, I think he actually kind of nailed it, because that's the 3 things I was actually thinking of right here.
Okay, wait, real quick.
Yeah.
I want to go over this. I want to go over this chart, right? So this is the 10-year, and I'll show it over the TLT chart. But it was just interesting seeing this move today, right? So we had the Moody's announcement come in on Friday, and you saw it come all the way over here, and the futures opened up, and the 10-year basically went up all the way to the high that we reached this morning at 4.56%, and the whole day the 10-year just dropped, right? And it's actually very interesting, because it was like, what happened today that could have made that happen, right? I always attribute this to October 2022, when the market basically bottomed on the worst, one of the worst inflation readings we basically got. That was basically the top of inflation, right? And the market bottomed, and you wouldn't have thought that the market would close green that day, but it did. And it's like somewhat of a capitulation, right? Like it's basically saying that sellers are just exhausted. In this case, sellers of treasuries are just exhausted, right? I mean, it could probably reverse and continue to go back up as far as yields go, and bonds continue to go down. But if I look at the TLT chart over here, you could see that reversal over here as well, right? TLT got down intraday to the mid 84s, and then we closed at the high of day in 86. I would love to see TLT to make a higher high, just to kind of cancel out this downtrend. But we need to see some follow through here, in my opinion. And I don't want to get ahead of myself saying like TLT bottom, but I think there's a pretty good probability it did. But I could be biting my tongue tomorrow, and TLT could be back at $84. So we'll see what happens with that. Let me share your screen right now when it comes to the the tweet you're talking about. Go ahead.
I was just putting out, I was just asking people like what some of the reasoning was, right? This one is pretty much, if the rental market data is accurate, there's three factors. One is self-deportations, which very well could be happening. You know, the data for that is still to be out there. So depending on what part of the country you're looking at, there's some level of maybe self-deportations happening, right? And it doesn't have to be a huge amount of people that self-deport in order to get this number down. It just means that it's happening. Airbnbs and second homes are falling to rental market as foreigners stop vacationing in the US. So I saw data that was actually showing a lot of European and Asian travel to the US is actually down year over year, right? Even with the dollar weakening, which technically means that they would theoretically be in more of a favorable position to visit the US, but because of some of the changes around, you know, immigration and possibly some issues around border and all this other stuff, a lot of people are saying, you know what, maybe I'm not going to go to the US. And, you know, the favorability rating of the US is not high right now among the rest of the world. So maybe, and especially Canadians. Like I know I was actually reading some data from Canadians that do a lot of travel during the summertime to Florida. And they literally, like, they're boycotting the US because of all the fallout from some of the Trump administration's comments about Canada and everything else. So the fallout around that could also be adding to inventory that normally would have gone to second, you know, to like, let's say short-term rentals. Maybe that's being fed into people trying to do longer term rentals. And so that could be increasing the inventory. And then another one is hedge funds and venture funds need to recoup cash flows at arms reset. This one is the one that I'm trying to do a lot more research into because, you know, when you have these multifamily homes, like I said, they're all financed through CMBS products, and CMBS comes due every 5 years. So there's a lot of debt on the corporate side that's coming due in the next couple of years because they were literally taken out during COVID. So that entire period, you had literally ZIRP, so zero interest rate, which meant your cap rates, even if you had a cap rate of about 5%, you were doing really well. You know, like, oh, I'm getting money basically for next to nothing, so I can borrow money cheap. And if you got a 5 cap rate, that was great. Now, if you have to refi, first of all, you need someone to actually give you a loan. And if you have to refinance at a much, much higher rate, your entire business in terms of cap rate is gone, you know? So the question here is, there were actually some, I know, landlords that were keeping homes off the market and what they would do essentially is do like the 3 months free, and then they would get someone who was paying quote unquote $3,000 when technically if you average it out to like over the 12 months, it was actually only like 2,500. So this way they could go to the bank and said, look, I have tenants that are paying $3,000 a month. That whole game is starting to be unraveled right now. So I think what's happening is a lot of these people, you know, they're basically going and saying, look, I need to get my occupancy up. I cannot have a building that's 80% occupied. I would rather lower the rents by a couple of $100 or maybe even $500, depending on which area you're in and the amount of demand there's out there. I would rather have a higher occupancy and make sure I'm cash flowing than the other way around, which is just showing that I have great cash flows on an average on an average rate. So I think that's something to just keep in mind. And I think as the market's putting more pressure on these guys and the ability for them to refinance, they're going to have to get their occupancies up, because at the end of the day, that's how you do your calculation, right? Like if you can't have a building that's 80% occupied and you're charging higher rents to everyone in there just to show the bank, like, yeah, if you have to lower the rent a little bit to make sure you get 99% occupancy or 100% occupancy, that's what's going to get you to that cash flow level that you need. So I think that's what's happening. At least that's my theory. I don't know if it's 100%, but I think as time goes on, we're going to see that we're going to see the data come out. And I think if the data is true, eventually it'll make its way into that core PCE calculation. And if that happens, the delay is usually about 6 months to a year. where a lot of the data that you're seeing with the Fed, you're seeing it almost like somewhat backwards because they do that stupid, owner's equivalent rent nonsense where they ask people like, oh, how much do you think your apartment would rent for? Or how much do you think your home would rent for? Like
It's not a good measurement. Yeah, it's not a good measurement.
I think it's like the dumbest thing in the world because you're not getting a real snapshot. You're just getting this sentiment bullshit. So I think if we use that we use that disconnect to our advantage, we could see that inflation is coming down, and it's coming down a lot more significantly than what the market is actually projecting right now. If that data is true. And like I said, this is something that we should monitor over the next probably 3 to 6 months and see if the average rents are actually coming down and maintaining that downward move, because that means that you're actually not going into disinflation, you're going into deflation.
Yeah.
You know,
I mean, I don't know if we're going to go into deflation. We'd have to have a dramatic recessionary contraction. I mean, we already had a contraction in GDP this quarter, Q1 actually, and it wasn't even as dramatic as people thought it was going to be. I think next quarter, I don't know, just seeing the uptick in the Fed now forecast, it might be positive, but I think the market's going to react positively if it is positive, if anything. Do you think rates bottom? Do you think rates topped?
I mean, there's always chances of some craziness happening in the background that causes, rates to pop up like we just saw with this Moody's thing. There's also some probability that we get a one-time increase in inflationary data from some of the data from tariffs that could also impact like yields. So like, let's say right now in the short to medium term, we get a spike in core goods because of like tariff worries and some of the issues with the logistical end of it, and businesses end up raising, that could theoretically cause some, overheated inflation data that gets corrected in the future, but that could spike rates. So I'm not saying that we've absolutely topped out in yields. I am saying if you look over the longer term, we're likely in a downward move. If it wasn't for these, if it wasn't for these tariffs, I don't even think Jerome Powell had any question why, whether or not to cut. He would have cut 50. I mean, he would have cut 25 in May. He would have cut 25 in June. And one of the things that he left the door open to was if they do see some weakening happening, like they have room to do like major cuts, like they did in September. That September hit was a 50 hit. Yeah, that September was like a 50% cut. So.
I mean, that's what they're waiting for. They think that if they cut too much right now, they're not going to have that firepower later on. And he wants that firepower because the Fed's not stupid. They know the market front runs the sentiment with sentiment versus what's actually happening, right? So it's a much different Fed Reserve that we're playing with versus the Fed Reserve that we had in the 1970s. I know a lot of people compare to that because in the 1970s, lagging data was the data, right? So today you have all this technology able to run models and everything. You're able to front run and markets run off the front running. So, they know that. They know. I'm pretty sure Jerome Powell's not stupid. He knows that every word that he's going to say is interpreted, and that's why he's very careful with what he says during those meetings and stuff. So, I think the debate can really go for a long time. But I think we got to be cognizant of time right now because we got a couple things we want to go through. I wanted to get into Nebius real quick because I definitely wanted to have some time for this. So Nebius is actually reporting tomorrow morning. Well, actually, it's in the morning in a few hours for a lot of people. I don't know if I'm going to be awake when they come out with earnings, but I mean, whatever, I'll wake up to it. But I wanted to go over some of the earnings forecasts that I have, and it's really not going to be much, guys. I mean, it's not a profitable company. They're not free cash flow positive. In fact, let me just bring up their latest earnings over here. All right, so this is their latest earnings. And like I said, they grew at 466% year over year. Okay, take that with a grain of salt. You're probably not going to see numbers this high next quarter. Maybe you will, but I don't think the market's necessarily looking for this number. Like, yes, that's a lot, right? But 600% year over year for their core infrastructure business. And when you think of Nebius, the core infrastructure business is the data center building business, right? Then they have other arms in their business that include, let me share this screen over here. They got other arms in their business, which includes Toloka. Toloka is a data partner. This is the one that Bezos invested in addition to the CTO of Shopify invested in this. The CTO of Shopify actually became part of the board. So that was actually pretty interesting. Triple 10 is like an online education course catalog that a lot of people can take, but they mostly cater to enterprise, but as well as consumers as well. AvRide is the autonomy business. And then there's ClickHouse that they have a 28% stake in. And ClickHouse was the one that had that crazy valuation news the other Friday. Basically, ClickHouse is valued like around $6 billion, and Nebius owns about 28%. So that means about $1.5 billion of just asset right there, right? So, and that's for ClickHouse, and their competitor, it's a Snowflake and Databricks and so on. But what I really want to get down to on their previous earnings, this is from Q4. So I think this was February February 20 they reported. Adjusted EBITDA for the entire business was $75 million at a net loss, right? So continuing operations, so negative operating income of $136 million. So like they're not close to profitability here, and the CEO Arcadi never made the assumption like, hey, we're going to be close to profitability. When it comes to their entire business, and because of the fact that the core business is building data centers, which is not a cheap business by any means, $2.5 billion on the balance sheet, not including the additional ClickHouse valuation. They have a lot to play with. But being that CapEx is forecasted to be pretty high, I wouldn't come into this quarter expecting CapEx to lower or anything. I'd expect it to be a lot higher, right? But the number that we really want to look for, really in the midst of all this, is the guide that they had for annual recurring revenue, right? So in December 2024, that quarter alone, the entire year, their annual recurring revenue was $90 million, right? What they're forecasting for this quarter alone is $220 million. So I'm sorry, Q4 ARR was $90 million. They are guiding for at least $220 million for this quarter. This is the number that we need to be looking for this earnings. If they are above this number, could have a positive reaction from the stock. If they're below this number, then that means that they might be shortcoming of their target of $750 million to $1 billion in ARR, and that might have detrimental impact to the entire thesis as far as the acceleration that's going to get to and how aggressive they might get there. I think they're going to beat this. I don't think that they would shoot themselves in the foot by providing this guide. If they do, does it ruin the thesis for me? Probably not. I would actually see it as a buying opportunity to buy more shares. But if they beat this, depends on how much they beat it, of course. But I think that the market's getting excited with all the sovereign funding that we've been getting in the Middle East, in addition to the market basically coming back from the April lows. The stock is up nearly 100%. Actually, it's up over 100% since its $18 lows in April. But just in the last couple of weeks, the stock is up like 40%. It's crazy. But with that set aside, right, as far as other earnings expectations, I mean, we can kind of go down the list here, but I think that's really what the market's looking for. Of course, people are going to want to hear some updates as far as the ClickHouse valuation. People are going to want to hear updates in the other businesses, especially AvRide, operating in Israel and parts of the US already, including their autonomy or robotaxi business, in addition to their food delivery business, which is also autonomy. And out of all their businesses, AvRide is probably the one that's closest to profitability and will bring a lot of money into the company. So like all these companies are really there to fund the core business, and that is Nebius, right? But they're all connected somehow with the AI workloads. So, I mean, we got NVIDIA owns about 4% of the company. They, of course, disclosed that in the 13F that just came out, and they disclosed additional investments in CoreWeave. Why is CoreWeave outperforming Nebius? I have no idea, man. Like, those are the crappiest earnings I've ever saw.
Bruh, who cares? Who cares?
I know, but who cares? See, that's the thing when it comes to this whole comeback of the market. All right. And I'm going to bring up a chart of core weave. And I went a little degenerate with core weave and made some money, but I'm not going to get greedy on it. But I would not be surprised if the thing gets to $100 sometime soon. But you look at this chart, dude. Why would you short this chart? There's no reason to short this chart. The premium is high, so buying puts is out of the question. On top of that, do you really want to buy this? I mean, you could buy it and gamble away money, you know, and you could probably make money, right? So I had 100 shares around $6,400, and I sold too soon around 70 something, but whatever, made some money off of it. The point is, those were terrible earnings, right? They guided for CapEx that's multiple times the revenue for next quarter. I don't know where the money is supposed to come on, but hey, I mean, you know, the eye of the beholder. Like if this stock runs to $200, I could look like an idiot. All right, so be it. But at the same time, there's no fundamentals behind this company that I'm extremely bullish on. Nebius is a very well diversified business in multiple verticals. On top of that, they're building data centers. They're building the data centers outside of the US. They're not just renting out the GPU like CoreWeave is doing. They're building the whole stack. They're running the software across the whole stack. They're renting out all the compute to customers across the entire stack, around the entire world. Okay, like, and on top of that, Nebius is a way cheaper valuation, and it's cheaper as a market cap too. So it's like, I don't know. Am I going to buy a business or am I trying to make a quick buck? Your choice, guys. I'm in Nebius. I'm in it for the long haul. Really going to be interesting seeing the commentary, considering there's a lot of retail following this, and I don't think they're stupid. I think they know that. Go ahead. You trying to share your screen?
Yeah. Take a look at this. They also got like some contracts to build the supercomputer for Israel. I mean, look, I'm going to say something. It's controversial, but I've never been one to not be controversial. You don't bet against the Jews. I would not bet against the Jews, bro.
Dude, honestly,
when it comes to tech, it's a stereotype. The Jews are very smart. They're very intelligent.
And they're wealthy.
I don't care about the wealthy part. I just know that they're super smart and they know how to run businesses really good. Okay. Like, I know this sounds stereotypical, but it's a good stereotype. You know, it's like
a good stereotype. Yeah,
so
it is a good stereotype.
Don't bet against the Jews. That's what I have come to learn over a long period of time. When it comes to Jews, don't bet against them, especially former Soviet, Russian Jews, Ukrainian Jews. You know? They're like the absolute like killers when it comes to technology, bro.
Okay? Dude, they're not.
Indians are good,
Soviet,
but
they're not Soviet. Like if this is a whole plan to
former Soviet, whatever,
Russia, then we're screwed, okay? Because Nebius is building data centers around the world. They have everyone's data, okay? So, okay, fine, former Soviet. But if this is a ploy of Putin to take over the entire world.
No, it's not Putin. I'm just saying former Russian Soviet era Jews. They are some of the smartest Jews on the planet. Like, you know who scores the highest in IQ tests? Ashkenazi Jews. Like, you just look at them. They're like off the charts.
Smart. They're very smart. You know? They're very smart genes.
Whenever I see some of these people in the boardroom, I'm like, sorry. I'm sorry, people.
Friedman.
I'm using my I'm using my stereotyping and racism for good, you know. So I don't know. I don't know if is it wrong to say that the Jews are smart?
Hey, like Steve Cohen owns the Mets. All right, you got a bunch of other.
You don't. That's
Steinberg and Weinberg.
Vlad Tenev.
Wow.
You know.
Okay, but no. Okay, there you go. I mean, come on, Hood is
Alex
out there.
Alex Karp's half Jewish.
He is?
Just
that's right.
Yeah.
He is. Yeah.
He's half Jewish. You know.
But I mean, you know, not gonna lie though. I mean, these are some really smart people who coincidentally
if you
Jewish. Okay, like come on, at the end of the day, like there's no race set aside. Like, you know, these are really smart people that are running these businesses. And to be honest, Israel is definitely a place where you want to invest because there's a lot of investment into defensive budgets, right? And with defense comes technology. With technology comes AI compute, and that's the reason why there's a lot of investment when it comes to AI technology, especially in the Middle East. Because if it's going to be defense, which has the most budget, the money's going to go there, right? So
you want to know what's even more powerful than Jews? Jews and Hindus combined, bro. Ruth Porat, Sundar Pichai, you got Google. You know,
that's funny.
Jews and Hindus bro. That's it. That's all you need, bro. You need that Jewish brain and that Indian pragmatism, and you are done, bro. You're gonna go to the moon.
She actually had an interview. Ruth Porat, she's the president of Alphabet. She actually had an interview on In Good Company. I got to check that out. I got to check that interview. That looks pretty cool. I actually, the
Who's the
Sundar
CEO of
Pichai.
Oracle? Who's the CEO of Oracle? Safra Katz. Who's
Well, she's not the head of Oracle. I'm sorry, but yeah, no, I know what you're talking about. Larry Ellison is really running the ship. Isn't that weird? It's like, okay, Larry reports to Safra, but Safra reports to Larry. So in essence, Larry reports to himself. So is Larry going to tell Larry to buzz off, let me do my job, or not? I don't know. We'll see. But anyways, Larry Ellison is one of the richest people on the planet. Safra Catch is just following the lead. Don't get me wrong, though. She knows how to talk to people. But anyways, I wanted to get a little bit into NuBank. That was quite an interesting earnings. Let me just take down the time.
Not interested,
here.
Not being run by Jews. Sorry. I'm just kidding. That's a joke.
Wow. All right. So let me bring up FinChat.io. So probably the best place to show you these metrics across the board. All right. So NuBank. Dude, did you dig into these earnings?
Not yet. I know they were good. I actually looked at some of it, but I didn't get a chance to look at everything. I know that they still haven't hit profitability in Mexico and Colombia yet. That's the only thing.
Might take some time. I'm not really digging for that profitability. I'm mostly focused on the growth rates over there. But what was actually really interesting was that yes, they're actually no, you know what? This is not what I want to see, because this is constant currency. I want to see non-constant currency, or whatever it's called. Financials, filing center. All right, let's go to the NuBank results presentation. Here we go. All right. I would recommend checking out these slides. They make really cool slides. I'm not going to lie. They present their information pretty well. So Dave Velez, CEO, you guys probably heard of him. Other people, yeah, they're all cool, but you know, Dave Velez is the face of the company. So 120 million customers, grew 20%. I'm sorry, it grew 20 million year over year. But their revenue year over year, FX currency neutral, grew 40% year over year, which is still pretty good. I mean, if you look at this chart as far as the customer growth, this is just bonkers how fast they're growing. I don't know if this is log scaled. Yeah, this is log scaled. So, well, no, actually, no, it's not. This is linear, so that's still good. Like you're saying, Mexico is not necessarily profitable, and neither is Colombia. But some things that note in here was that their monthly average revenue per acquired customer is still going up, which is phenomenal. 120 million customers. The cost to serve these customers is going down, so they are increasing the bottom line, becoming a lot more profitable as far as gross profit goes. So that seems to be going up. But at the same time, this quarter wasn't necessarily the best quarter when it comes to the margins, because one thing that they did report that wasn't exactly what the market wanted to see, which they're getting very criticized on by Wall Street, is the net interest margin. The net interest margin is basically how much they make in net interest income, which is basically the core profitability of the business. They get the money in, and then they turn around and they loan out that money and try to make money off of that spread. And the net interest income went up, but the net interest margin went down 20 basis points. And that's not really the direction you want to see when it comes to the company over a long term. If you look at Q2 2024, this is just basically a downtrend. But they've said this many, many, many times. It costs money to expand very aggressively in Mexico and Colombia. NuBank has business in Brazil, which is 90% of their income. Revenue. They have business in Colombia and Mexico, which started in the last decade, right? So in order to rev up and ramp up in these untapped markets, you need to market hard, and you need to provide a lot of incentives, and eventually you reduce your costs on marketing and incentives, and the thing just has the flywheel effect on its own, right? For now, though, we're in the growing phase. So you have to spend money to make money in these countries, right? And that's the reason why you saw this downtake. In addition to that, one thing that I did like from this quarter was, also their gross margins went down by about 5%. Market didn't like that, of course. There's a bit more to explain that. They were talking about seasonality, but also the credit loss allowances that they had in this quarter. I don't want to get too detailed on those numbers, but they did have commentary in their earnings call regarding this, by saying that, look, they have a bit of leg room when it comes to the amount of risk they can take with their clients. Overall, a lot of their clients and customers are overall getting much better credit, because that's just how things are in Brazil per se, since 90% of the customers are in there. But overall, they're getting better credit. But because people have better credit, that means that the interest you charge them is going to be lower, which means that you're going to be making less money off them. But they had to adjust for credit losses, and that's the reason why you saw this hit on the gross profit margin. I think this is going to start coming back this quarter as far as the margin goes, which is what the market likes to see. But nevertheless, I thought it was a great quarter as far as FX currency neutral. 40% growth is still really good. The market's criticizing them for, it's like, oh, their growth rate is slowing down. So what do you expect? Like, they're such a big bank at this point. It's like they can't grow at like 40%, 100% year over year all the time. You need to focus on the profitability, but that didn't come through. So that's why they kind of got criticized for it. What was another thing that I wanted to talk about in here? Yeah, okay. So net income margins, of course, got readjusted downward, which is okay. On an FX neutral basis, it is still going up and to the right, which means that they're contributing more to the bottom line. But as a percentage of revenue, of course, that came down a little bit, and the market doesn't like to see that. So there's also that other chart that I want to show you. Oh, yeah, this is a seasonality when it comes to the credit book. You have the 90-day plus non-performing loans, and this is basically loans that are overdue by 90 days or more, and that's ticking down. Like, that generally means that's good. That's less risk they need to account for their loan portfolio, which means that that's more money they can loan out. So if you assess your risk and aggregate it over all of your customers, and it's down to 6.5%, down from 7.2% in the last couple of quarters. Before last quarter, see how this has been just going up and to the right, which means that more people are becoming delinquent under loans 90 days plus. They were getting criticized left and right in these earning calls about that. And they just hated, clients just hated the fact, analysts hated the fact that this number kept going up. And now it's coming back the other way. So all of a sudden that looks good, right? And then they made a comment about this one going up as well to 59 days. And this is a credit loss they had to adjust for that showed up on their earnings, which did show the margin contraction. So I think this is just completely normal. I mean, like, there's nothing crazy that's happening outside of here that's unexplainable. These are just minor seasonality adjustments here that you've seen here. You know, nothing crazy. Like, going from here to here is a big deal. Going from here to here is not such a big deal, right? But this is trending in the right direction, which I do like to see. There was actually another chart here. Oh yeah, these are just additional metrics. If you want to see these, you see that growth rate is slowing down a little bit, which is okay, because look at their revenue they're getting per quarter. They're over $3 billion this quarter, which is great. Gross profit, of course, did drop down a little bit, which contributed to the 5% drop in gross margins. But overall, their net income is going up, but that's always good to see. And they're talking about seasonality, of course. So if you look at 1 year ago, 379, look at the next bump they had in Q2. So you could expect Q2 to be a big bump up according to seasonality. So we'll see what happens with that one. But of course, you know, if the market rallies back up from those April lows, people get a little bit excited. They get a little bit of friendly. Hey, there's more money in my investment account. I'm going to spend a little bit more money, and so on. And plus, on top of that, with the AI wave coming, they're going to reduce their costs with the technology they have, which they were talking a lot about in the call. And one thing I wanted to touch on with NuBank is that this is a bank, but they have so much data on all their clients. They are a digital first bank. They're a digital native bank. They've never had, or maybe they have a couple of branches, but mostly for headquarters and mostly for administrative stuff. But just think about how little overhead that is. But because of the fact that you're more of a software and technological company versus focusing on the administrative stuff of owning a branch, you have all this data across your entire platform. And what can you do with this data? You could target certain markets. You could put less money into this market and more money into this market. This is why I'm like so bullish companies like Robinhood. I'm so bullish on HIMS, Amazon, and so on. It's because they're collecting all these data from all of their customers, and they're growing their customer base, which means that they're getting even more data. And if they're running models on all their data, they're able to figure out ahead of time where they can cater to or what markets to target over time. And I mean, I think that NuBank is definitely killing it as far as that. I mean, 120 million customers, that's a lot of data, but that's also a lot of alpha you can have for where you're going to point and market to people that you want to sell services to. So yeah, is New or SoFi more exciting? NuBank's more exciting, without a doubt. Way more exciting than SoFi. But I'm not a shareholder of SoFi, so I'm biased. But yeah. You sell NuBank?
Yeah, of course. Loving my NuBank
Nice.
position, bro. Got more contracts than I know what to do with.
Yeah, that was good. That was good. You know, and the funny thing, I think we could talk about it right now because it's already near $14. But I mean, we were pounding the table on this. We were pounding the table on this to the Patreon around like $10 just the beginning of this year.
Yeah.
I mean, NuBank, of course, is up like 40% year to date, but that's because they started at their lows. But during April, NuBank was chugging along, right? So
we did really well in doing a spread on this, but the way we did it was smart. When things were oversold, we bought calls, and I recently married all my calls, so I got most of my money back. So now it's pretty much a risk-free upward move between the strikes that we have, which is amazing because that's essentially what you want to do when things get oversold. You know, you want to buy calls, and then, you know, when things do this V-shaped recovery mode, you sell calls against those calls, and basically you pull all the cash out and you get this nice spread between the two strikes. And basically the amount of risk that you're taking to get this huge amount of return is next to nothing, you know, which is perfectly how you want to roll these things up. So I think NuBank, it was a matter of time when there's these FX impacts would, you know, diminish, and then people would realize that this thing was a great place to be. I mean, the growth rate is there, everything is good, so they're going in the right direction, you know. So
yeah, I would call it a solid win at this point, because as you're basically saying, I mean, I'm in it for the long haul, but I do still have some naked calls in there. But I mostly accumulated all those shares in the single digits more than a couple of years ago. But I added much more to my position when it pulled back to like $10, and it was great to get at that price. I mean, you know, we could obviously turn around and revisit those lows, but I would think that you'd have to have some sort of dramatic macro effect for that to happen, which then everything's going to be on discount. But yeah, I mean, if you guys want to find out more about this, or if you're new here, you know, I go ahead and check out the Patreon at the link below. You know, we definitely have much more things we talk about other than NuBank, macro oversights. We also have private pods as well. We just had one a couple of weeks ago that we released to the public last week. But yeah, go ahead and check that out, guys. Link is also going to be in the description as well. But yeah, man, top of the hour here. Was there anything you wanted to go over?
Just one thing really quickly before we go.
Yeah, go for it.
Which is this right here. I don't know if it's 100% true because it's just data, but Morgan Stanley says ChatGPT remains the top choice for teens and Gen Z, but usage among 25 to 34-year-olds is now split between ChatGPT, Meta, and Google. Among older age groups, ChatGPT has gone flat over the past 6 months, while rivals have gained ground. Gemini showing the strongest overall momentum. So I think a lot of what people were saying about how ChatGPT was going to essentially kill Google, seems like hold on, go ahead, Sam. No, you're muted.
Did you see this on Poly Markets? I don't think you saw it.
Let me see. Well, Google I/O is tomorrow. I'm going to be paying attention. So
which company
AI
is the best? Yeah.
Wow.
The best
really? Google's got the best?
A landslide. By a landslide. I didn't bet on this. I don't know why yes is highlight. I didn't bet on this, guys. I should have bet on it, but I didn't bet on it.
Is Sundar using his extra cash to buy this?
Well, if you look at this chart, it's been going up since OpenAI was tied since April 22nd. And it's interesting because, like, what happened to April 22nd? That was like what happened? Did new data come out? But like, it's just been trending up since then. I mean, you could have bought the dip here if you wanted to, but this is just a landslide victory.
Let's ask the chat. Chat, is Google Gemini better or is ChatGPT better? I'd love to hear from the guys in the chat. So in the chat, just if you have a second, what's better, Google Gemini or ChatGPT? One for ChatGPT. Can you do a what is it called? Like a poll? No, you can't.
I don't know. I'm not on it. I don't know how to do that. I think I have to do it on the actual YouTube stream.
Yeah.
But yeah, no, I don't
I
know
think ET FaceTime is right. I have
actually
used
that's
ChatGPT. I've used ChatGPT for certain tasks, and I've used Google Gemini for other tasks. If you're an engineer, it's Claude and Gemini. I haven't used ChatGPT in over 6 months. Don't know which is better, but Gemini is just integrated with all the stuff I use. I use Gemini, but I think there's a convenience factor.
I use ChatGPT. I'm sorry.
I use ChatGPT too.
Yeah, I'm used to it, so I haven't switched over to Gemini yet. But I know Google has that offer. If you have Google storage, then you can add Gemini there for like an extra $10 with 2 terabytes of data. So I might check that out. I might check it out. But then I'm hearing people like you can't go back after you do that, and that kind of worries me. Stupid Google always does that. But yeah, I mean, honestly, that was a baller interview with Sundar Pichai.
Yeah.
Like that was, he kind of put that to rest, in my opinion. I'm actually surprised. Well, the market was down today, but I wouldn't be surprised if Google comes back. Mostly because that sentiment is dissipating. But if these guys figure out a way to monetize AI search, which right now it's not monetized, that's it, man. Google's going all-time highs after that.
My theory on Google is that you've got 2 things happening. You're still going to have your traditional search. I think traditional search is not going anywhere. Like right now, I was looking for, like I said, I was looking for a restaurant to go to with my wife this evening. I didn't go to ChatGPT and ask, what's the best restaurant to go to?
It's just, you got your bubble tea.
Bubble tea. Yeah. So I was just asking that. So boom, I just went right to it. You know, if I have a general query about something, I'm not going to sit there and try to figure out what prompt to get
I'm
to a place. You know, so in that respect, like if I need to book a flight, I'm not using ChatGPT to book a flight. I'm actually going to Google Flights and looking at the calendar and figuring that that whole thing out, which is what works. And I think that's where most of the monetization comes from. So if you can get that monetization plus now Google Cloud, which has all this AI integrated into it, that opens a new line of business. So instead of thinking of this as search is ending, I would think that this is like search is slowing down, but then you have this giant AI thing coming in and boosting future growth prospects. You know, and I think Google is smart enough to figure that out. And especially if they own the like even NVIDIA today, did you see the thing with the NVLink thing?
Yeah, with, the Fusion.
I think that was very important to say that, you know, it's not going to be an NVIDIA only world. Like Google's TPUs are still really good. So I think what it is we're looking at this the wrong way, where it's like, oh, AI is going to kill Google. I think Google is smart enough and the people at Google are smart enough to figure out ways to monetize the crap out of this whole thing.
No, I wholly believe that they will figure it out. They will figure it out. Like it's just, they've been able to figure themselves out of so many things, and everyone always gets bearish Google at some time, you know, and so on, you know, like my reasons for selling is not, you know, it has nothing to do with the fact that I don't think Google's going to make it. It's more of opportunity cost, but either way, like, but without a doubt, like they're going to figure it out. And I think they're going to come out on top of it. How can Google Maps, actually, oh yeah, they're already monetizing Google Maps. They always have the advertising in the corner. But see, my problem is whenever it comes to AI search is how is that going to work, right? Like, are you going to put the sponsored stuff at the top, or are you going to recommend the sponsored stuff? Because if that starts happening, no one's going to trust the search anymore. They're not going to trust it as much. It's hard to say if they're going to not trust it in the future because, well, they have sponsored results, right, for Google search, and then people just scroll past it. I always scroll past it, never look at it, but then I'm sure a lot of people click on it, and that's how they make their money off of it. But I don't know if they do it for AI search, like if they somehow implement it in a seamless way, which is not that hard for them to do, I as soon as they start doing that, I think Google's going to all-time highs, like just without a doubt, because that's going to put it to dead. The whole AI is going to kill Google thing. Like it's going to put it to bed at that point because now they're monetizing it, right? I think the cat's going to come out of the bag before it actually starts happening, but we'll see. Jocks actually talked about that for a minute when I went over the NBIS earnings preview. So yeah, with that being said, man, let's wrap this up. Again, recordings live soon as we end this, probably even before that. But if you didn't get a chance or if you didn't hear about it, NBIS or Nebius reporting tomorrow morning. So if you're watching this tomorrow morning, earnings are probably out. And from what it looks like overnight, it looks like earnings already happened. Let's see here. Oh, yeah. Yeah, it's up 4% still. So not bad. But we'll see. We'll see what happens with that, man.
Yeah.
Any last words?
No, I just Google, man. Google's the only thing I've got to read about. Some of the stuff with Waymo too. I think that
was pretty interesting.
That's one of the other things that, like, tomorrow with Google I/O is going to be very important because it's going to show a lot of the extra things that these guys have. Like if you look at Waymo, like if you search on Twitter, just type in Waymo, dude, the amount of content around Waymo and autonomous driving is insane now. Like it's a big trender. So I think like Google, like it's available in my area now in Atlanta. So, you know, and I think next year they're going to target a lot more cities as well. So I think that is probably going to end up creating a whole new business. And I think in 5 years, the prospect of what is that thing called? Like autonomous like taxi networks is actually going to be a real thing. And I wonder if it's going to be like autonomous cars. Like you have a Tesla, right?
Yeah, like, I have a Tesla, and they're talking about turning on. I'm not letting strangers ride in my car, man. Get out of here.
No. I'm saying, are you an FSD guy? Like,
no,
did you go to Vegas?
I don't have FSD. I'm not.
Why?
I'm not paying $100 a month for that. Get out of here. I'll drive myself. Honestly,
it's not that good.
If you, okay, so Teslas have the ability to auto steer. So if you've ever been to Vegas from LA, it's literally one road. So like, I don't need to pay FSD for this. Like I just have it auto steer, right? And it was actually I got a funny story, and then we got to wrap it up after that. Okay. But the Vegas speed limit on the way there is like 75 miles an hour, right? So I have the auto steer on going 90 miles an hour, right? Or 95 miles an hour. Everyone's going 95 miles an hour, dude. Everyone. If you go less than 90 miles an hour, people are honking at you and you got to get out of the way. Like, I'm not kidding you. So I'm letting the thing steer for me 95 miles an hour. And all of a sudden, like, this car pulls up next to me and the people are just looking at me, right? And I could feel it in the side of my head. And then I turn over and it's a cop. A cop is just staring. Like, they're both just looking at me. The cop in the driver's seat, the cop in the passenger seat, just looking at me, right? And I turned for a minute and I didn't really notice. And then I was like, oh crap, my wife's like, you need to slow down. It's a cop. I was like, oh my goodness. So I slow down and the cop just like zooms off. And I was like, wow, that would have been like a $600 ticket right there. I was going easily 20 miles above the speed limit, but everyone is driving 90 miles an hour more. It's like, why are you picking on me, bro? Why are you picking on me? Anyways,
I think he was seeing if you were on like autopilot and sleeping, because that's the one thing.
That's
like,
true. Look, he was dead staring at me. Like, they were both looking at me, like what is wrong with you? That kind of look. Like, are you kidding me? Type of look.
You got lucky. Kind of you're too light skinned to get pulled over. You're too light skinned to get pulled over, bro. That's what it is. True. I'm like right now, I got the light in my face. Otherwise, if you look at me, I'm pretty dark, bro. I'm getting pulled over every day. Not every day.
I'm probably just as tan as you, but I got the light in me too, and I got very dark when I went to Greece. So, you know,
okay.
But my car is very tinted, so you know, I could have been white, and they could have thought I was just some white dude and just thought whatever. So
okay,
we'll see.
All right, just saying, bro. I got pulled over, and like they're like, oh, okay, I see you. I see you. All right, all right, guys. Man. Well, it's a pleasure. Have a good one, and take care.
All right, take it easy.
Later.